Hello everyone, thanks for joining us today. As before, the webinar will be led by Jerome Stern, our managing partner, and our CIO, Chris Rosbach. They will be joined by Katerina, who is Deputy PM on the World Stars strategy and also Head of ESG. We plan to speak for about half an hour in the presentation and then move to Q&A. We already have some good questions, but please do send more at any time. I'll now hand over to Jerome.
Good afternoon to everyone. Thank you for taking the time. It's a pleasure to welcome you to our latest investment update of our World Stars Global Equity Strategy. J. Stern & Co. is an investment partnership today, managing 1.2 billion on behalf of families, wealth managers, charities, and institutions. About 25% of the assets are managed on behalf of my family, providing a powerful alignment with our investors. Our core philosophy is axed around three main principles: invest for the long term, do your own research, and invest only in quality. Our World Stars Global Equity Strategy invests in a concentrated portfolio of 20 to 30 leading global companies, and we define quality, which for us is a defining condition, as four key criteria: strong and sustainable market position, good and growing industry, great management with long track records of value creation, and strong balance sheets to weather adversity. At this stage, our World Stars Global Equity Strategy has produced impressive results, both from a long-term as well as on a shorter-term basis, both in absolute as well as in relative terms. We can be proud to show 9% annualized performance in US dollars since the 1st of January 2015, as well as 15.6% year-to-date in US dollars, which are both significantly above the index. Both of these results show both long-term and short-term quality of our investment process, and I feel very optimistic about the future and about the continued prospects of the strategy. At this stage, I want to hand over to Chris.
Thank you, Jerome, and welcome everybody as well. It's a timely moment, I think, for an update. We want to start just with a reminder. Jerome highlighted the quality criteria that we are focused on, but for us, another key attribute of quality is sustainability. We firmly believe that only companies that are sustainable in the way that they go about their business also are able to have sustainable competitive position and generates sustainable returns over time. So for us, both the fundamental approach that we have to our analysis as well as to the analysis of the ESG factors that affect our companies is of great importance. And that's because some of the big issues that we're facing, many of which are around sustainability, whether that's the energy transition or whether that is the move to net zero or other types of challenges, are issues that are disrupting economies and that are disrupting companies. And for us, quality is a forward-looking thing. So we want to be invested in the companies that are doing the disrupting, not in the ones that are being disrupted. And so what we've done here is we've just highlighted some newspaper and website headlines that we found around some of these big issues. One of the big issues is computing capacity. Last year's thing was the metaverse. This year it's AI. But what it is computing capacity. The world needs computing capacity in order to take the digital experience forward, and whether it is through the applications and the use cases for AI, whether it's through the development of the metaverse, which is going to change the way we're all going to access the digital experience, or whether it's through the applications in industry and other areas through the Internet of Things, automation and other applications, it's very clear that we need the computing capacity to drive all of that. And the companies that are involved in it, NVIDIA, which has been a core position for us, or ASML, which is another important enabler of this, are very important companies for our portfolio. Or other issues that are more closely related to sustainability, It's the crumbling of the global capital infrastructure. We think we're in the 1950s in terms of the age of the US and the European capital bases, and something similar can be said about China, where the average age of the asset base is as old as it's been, and where very clearly there is a tremendous demand in order to renew it. The number in the US is something like $2.6 trillion that are required to renew the US asset base. And in the UK, we've seen it around the crumbling of the schools where concrete has been used that has past its useful life. And for us companies that are involved in that, and we've talked about companies like Eaton in the US or Sika in Switzerland, are key enablers of that. Or final thing, which is water, where it is very clear that there is a tremendous need to improve the water systems in the US. The number is 750 billion that's necessary in order to maintain water quality. And again, here in the UK, we've seen that the big public water concession companies have underinvested over decades and are discharging sewage, are not able to maintain the quality of the water supply and need billions of dollars of investment. It's one of the reasons why we don't like government-related businesses or concessions, because of the incentives and the issues that they face. So there are tremendous challenges that the economies and we all are facing, and it's the types of companies that we're investing in that are at the able and working on helping to resolve them. And so with that as a backdrop, I want to talk a bit about the environment and where we think we are. I think like the Frank Sinatra song, My Way, I think that the record shows that we've taken the blows. We've taken the blows on inflation last year. We've taken the blows on the interest rates that have now increased to a level that are back to normal for the first time since 2015. And we've taken the blows on valuations with the big sector rotation that took place last year that is partially reversed this year. But that means that many of the companies in our portfolios are at exceptionally attractive valuations. So all three of those important factors are now things that have taken place. And our view is that we're building a plateau from which we can now look forward to what happens next. There clearly is an impact, and I think one of the interesting things, you see it here, that as the US Fed has raised rates towards the levels that it has, that inflation is now coming down. Some of the headline inflation is increasing again because of commodity prices and oil increasing again, but the core inflation continues to moderate. And we think that that is more likely than not to continue. And it's importantly, and this is another statistic from the US where you can see that the US labor market is slowing. There are different discussions about that inflation will stay higher for longer, and we certainly think that it will be pervasive. At the same time, that rates will stay higher for longer, and we see no issue with that. 4.5% interest rates to us seems a perfectly sensible number. And we are not concerned about that at all. But the important thing is that there is a lagged effect of the impacts. That is the moment that we're in right now. The US economy and the US consumer is resilient. And our expectation from the fundamentals of the companies that we've invested in is that we expect that to continue. But at the same time, we think that the US Federal Reserve and other central banks will be responsive in a very important and critical period of time in case there are signs that the tightening has in fact gone too far. You can't have it both ways. Either you expect that the tightening has not gone far enough, or that it hasn't. And so we think that more likely than not, we will be looking at the golden path, as we wrote about, as Austin Goolsbee, the head of the Chicago Fed, called it, with a study that it was analyzing the lagged impacts and calling for caution in terms of further rate rises. And I think we saw that just now, or whether it's Goldilocks or one of the other expressions that people use. If we then look at what that has meant for markets, we've shown this analysis of the factors that have been impacting our portfolio. And what you see here is that you have the total active return of the portfolio with the higher than 85% active share. You've seen you see the factor return, which is the gray line, and you see the selection effect, which is the blue line. And so the important thing, and this is since January 2020, so it encompasses the entire pandemic period with the issues, then the reopening, and then the normalization that we've just gone to. And what you can see there is that the selection effect that we've had has basically been positive or has dipped down to neutral throughout the entire period, and that the entire impact on the portfolio has been due to factors. And clearly, with a portfolio that is looking to invest in quality companies that can compound over the long term, we are going to be exposed to quality, we are going to be exposed to growth over value, we are going to be exposed to momentum because the companies we've invested in have done very well, and we're going to be exposed to interest rates in the sense that these kinds of companies are perceived as longer duration and therefore as being more interest rate sensitive by market participants. And that's what you see there. The entire pullback was explained by the factors that have affected the portfolio. Those factors have reversed very, very strongly this year, and what you saw is that the first thing that affected our performance is the reversal of those factors, and that took us through till about the first quarter. But you can see from the first quarter, actually, the factors have effectively flatlined, and our stock selection is what has driven our performance this year. And very interestingly, and as a snapshot of what's happening right now, you can see what's happened with the moment that we're in, where people are concerned about either rates are too high or inflation's too high. This specific moment, you can see that it's the factors that have been taking the market down. And so it is people positioning themselves again on the short term for what they think is going to happen. And that's what's affected our portfolio. You can see so far the stock selection has actually been effectively neutral. It's dipped down a little bit, as you would expect, but that is where it's at. And so our lesson, looking at the underlying results of our companies, but also at this kind of analysis of what markets and what investors do, is that it's not just volatility that is an opportunity for long-term investors, it's this kind of factor rotation as well. So, so far the portfolio has been resilient, and if there were a further reversal as a result of what happens, we're very convinced that it will be a buying opportunity, as it has been in the recent past. And if you then turn to what that has meant for the portfolio on a year-to-date basis, this is a list of the stocks that we own in the portfolio. You can see there is a cluster at the top that is companies that are broadly in digital transformation, one of the key areas that we think will be a beneficiary of these big drivers that we've talked about. And the top performers are NVIDIA, which we bought in February of last year, and we bought more in November. Meta, which we've owned for a long time, and Salesforce, which we also bought when it sold off as part of the pullback that was pandemic related 2 years ago. So these stocks that were among the worst performers last year are among the best performers this year. But importantly, it's not just the rotation and the factors, which you saw on the previous chart. It's very, very importantly the fundamental results that have come through. In the case of NVIDIA, which I'll touch on in a bit more detail, it's the tremendous demand. In the case of Meta, it's the resilience of digital advertising, which was the issue last year. With Salesforce, it's the fact that while corporate spending is being held back by the uncertainty, that it continues very strongly. Likewise, on the poorer performing side, you see it's some of the companies that are interest rate sensitive, like like American Tower, or that are being impacted short term by capital allocation issues with their customers, like Xylem, the water company, which is providing these solutions to the water issue that I highlighted, or RTX, which is facing a specific issue that we're going to take you through in just a moment as part of the updates on the stocks. Before we get to that, I just want to spend one more moment looking at the attribution effect that's been impacting, which ties all of this together. Because looking at the portfolio, you might think that we're very overweight in these kinds of tech and related stocks, and the truth is we're not. We're actually underweight in information technology in the portfolio. We only have a very modest overweight in communication services. What is very clear is that we have strong underweights in the industries that we we think are being disrupted. So energy, utilities, and financials are areas where we have either little or no exposure or very differentiated exposure. And so the combination of these things is what explains the performance. But the thing to really highlight is the dark blue bars, because you can see that in many very important cases, we are outperforming the allocation to the sectors. So the point is not only, I think, are we right to invest in the broad sectors that we do because of the quality criteria, but within those sectors, we're picking the right stocks. And those are the two sources of adding value and of adding alpha that are really critical to our investment process. And so if we then look at what has been happening more recently, it's really remarkable after the second quarter that most of our companies, there's currently 29 stocks in the WorldStar's global equity portfolio. You can see that most of those companies have had either unchanged or increasing guidance in terms of the earnings and the outlook that they provided after the second quarter. We base our investment decisions on the fundamentals of the companies that we invest in. They clearly, we look at their the companies themselves, at their suppliers, at their competitors, at their customers, and we try to build up a fundamental picture that we quantify. But it's really remarkable how resilient these companies have been. Only 5 of them have had declines in their outlook after the second quarter, and that is with all the challenges that are taking place. So this is one of the elements that is giving us confidence in the resilience of the companies that we've invested in. And again, that with the impacts that we're having from the interest rate rises, which is the fundamental impact that they're facing, that we think the likelihood is that they will be resilient. And of course, that's the moment we're in right now, where we're finding out whether this will be the case for the remainder of this year with the third quarter results that we will get in October, and then the outlook into the next year. But we think it's going to be driven by these types of, will not look all that dissimilar from what we've heard and what we're learning from the companies now. And so with that, we want to talk about some stocks. The first one I wanted to touch on is NVIDIA, for obvious reasons. It's our largest position. Again, we bought it in February of last year. It has been a stock that we have been watching because we've known about the quality of its business and about the strong demand that they have, but we have been holding off because we thought it was too expensive. So in February last year, because of what happened, it became cheaper. We bought it. It became cheaper yet, and we bought more in November. The thing to really highlight, it's a $1 trillion company. It is driven by the enormous growth that we've been talking about. We expect that the revenues will significantly increase fourfold over the next 3 years, and the profitability, because of operating leverage, will grow even more quickly. And the thing to really highlight is that the stock has earned itself into its multiple, as it were. We base our decisions on discounted cash flows, but you can see on 2024 estimated numbers, which we think are realistic, if not conservative, it's trading on 25 times price to earnings as a shortcut for other valuation methodologies. That is not expensive for a stock that has a period of competitive advantage that we think lasts for at least 10 years before anybody even will remotely catch up. Of course, the question is how much of the orders have been pre-done because of the scarcity that has been taking place. But that is something that we're looking at very, very carefully. And we think that the demand is tremendous. And one of the reasons we think that is because they've had tremendous new business wins. It's not just the biggest companies in the world that are their largest customers. It's a much an increasing and growing number of businesses. It's the big cloud computing companies. Of course, it's the big digital platforms in the US, but you can see AWS is obviously collaborating, as is Google Cloud, in terms of the partnership. If these companies could produce those kinds of GPUs, they would, but they can't. But it's expanding. So it's autonomous driving, Mercedes-Benz and others, as that market grows and becomes more competitive, which is something we're expecting. It's Tata, but also Reliance and other businesses in India, enormous markets that are investing, innovating, and it's Saudi Arabia and the UAE that are investing. And these are countries with initiatives and resources that rival the biggest companies in the world in terms of the investments that they can harness for their purposes. So we think that the evidence is very strong. If you look at the numbers, if you look at the backlog, that NVIDIA has a strong prospects. And again, the important thing is the valuation continues to be very attractive. With that, I want to turn over and invite Katarina to comment on RTX, a company that we've been invested in that is a core position for us, but that has been facing some challenges. Katarina?
Hi, thank you, Chris, and good afternoon, everyone. So I'll talk about RTX, formerly known as Raytheon Technologies, and as Chris mentioned, a core holding for us over the last few years. The company was created as a result of the merger of United Technologies and Raytheon back in April 2020, and the merger effectively created the largest tier one supplier in the aerospace and defense market. To give you a sort of flavor of the depth and the breadth of the company's capabilities, Collins Aerospace, the largest aerospace system provider in the world, has over 150 product lines with content in 100,000 airplanes around the world. Pratt & Whitney, one of the largest providers of engines for the commercial as well as the military market, has an installed base of over 10,000 narrow-body engines out there. And Raytheon, a leading provider of missiles, missile defense systems, as well as command and control system, is a key solution provider in all the battlefields that we are seeing today. You will have heard last year as well as this year of Ukraine using Javelin and Stinger missile defense systems. These are produced by Raytheon. You would have heard of Poland accelerating the delivery of Patriot defense systems. Again, Raytheon is a key content provider into that platform. So an unparalleled breadth of capabilities. In addition to that, if you take a step back and look at the drivers that are fueling the operating dynamics of the company, commercial travel is in its sweet spot. So we are seeing a recovery in travel activity. We've already seen it in short-haul travel. We are seeing that unfold now in long-haul travel as consumers like the Chinese consumer return effectively to international travel. And that's on the shorter term, and on the longer term, air miles and travel activity continues to build as the world becomes richer and people want to go out and discover the world. On the defense side, Chris alluded to some of the big geopolitical conflicts like Taiwan, sort of the tension around Taiwan. I mentioned Ukraine. Unfortunately, the peace dividend that we had enjoyed in the last few decades is firmly behind us. Great powers are fighting for their influence in the world, whether that is Russia or whether that is China. And therefore, defense spending is picking up significantly. And we have seen government announcements, not just in the US, but also in Europe, supporting that thesis. So very strong momentum in both of its key end markets. And then the final point I would make is there's a self-help also on the RTX story. So as a result of the merger, the company underwent a cost efficiency program. They've announced synergy target of 2 billion that they are on target to achieve. And on top of that, the merger created or gave access to the combined capabilities of these of the two companies, really solidifying its presence in key next generation technologies like hypersonics. So a self-help element, very strong end markets, and very strong product positioning within those end markets. This is what has been driving the stock, and actually it was the best performing stock in the portfolio last year, up 20% against difficult markets. It has struggled this year, as Chris mentioned, and as you saw on the previous slide. Why has that been the case? The company has had an issue with its geared turbofan engine platform. That is the next generation narrow body engine that fuels, among other things, the Airbus 320neo. The issue has been that, and I should say that the GTF is the key next generation and flagship program for RTX and the Pratt & Whitney division. It had a step change in key performance characteristics, whether that is fuel efficiency, emissions, as well as noise. And it is expected as we go into the next decade to reach in itself an installed base of more than 10,000 engines. So a very significant program here for the company. The issue it has faced this year, the company has announced in recent months that it will have to undergo an accelerated inspection and maintenance program for the fleet manufactured in the period 2015 to 2021. Why is that? They have discovered a historical contamination issue in the powder metal used to manufacture certain engine parts, more specifically the high pressure turbine disc part. And therefore, and that affects the performance of that part, and effectively it needs to be inspected and replaced at a shorter interval than initially planned and modeled for. So the company has announced, as I said, an accelerated inspection program for the period 2023-26 to fully resolve the issues. The problem is that comes at a time when travel activity is booming, as I mentioned, and that means that MRO facilities are full, and there are supply chain constraints in the value chain. And therefore, there will be queues effectively being formed as a result of this, inspection program, and the engines will stay off wing for longer than expected, and that leads to compensation effectively requirements for the airline customers. So it will be expensive. The company has said that they expect the gross financial impact to be between $6 and $7 billion, of which 51% will fall to RTX, the rest to its partners. And the cash effect for the period 2023-2025 will be $3 billion, ultimately reducing in the year 2025 the free cash flow of the company from an expected $9 billion to $7.5 billion. So a serious issue, but what I would say is that although the numbers are large, they have to be understood in the context of Raytheon. So $1.5 billion effect in 2025, that is in the context of a still $7.5 billion free cash flow generation by the company. The company has the balance sheet and the capability, the financial capability to absorb the impact. In fact, it has reiterated its target for a capital return to shareholders via dividends and buybacks of 33 to 35 billion. I repeat that, 33 to 35 billion for the period 2020 to 2025, and it has reaffirmed its sales growth targets and margins targets for the period to 2025. On top of that, important to remember, this is a company that has a significant backlog of over 180 billion across the three divisions, and therefore well supported for the years ahead. So a serious issue, we recognize the seriousness of it, but the stock, as you saw previously, is down more than 25% since the announcement. It has led effectively to a 30 billion correction for an issue that's going to cost it 3 billion, and the stock is now trading at around 13.5 times 2024 multiple. So given the strength and the structural drivers, given the company's positioning, given its balance sheet, given the valuation, we think it's a very attractive holding at current levels. And with that, I'll pass it on back to Chris.
Thank you, Katarina. We're very happy to answer questions about any of the stocks that are in the portfolio that are interested in the Q&A, and look forward to that. With that, I'll take us forward. And what I wanted to just talk about in conclusion is just looking at some of the performance numbers for the portfolio as a whole. And what you see here is the performance of the WorldStars Global Equity Fund net of fees versus the MSCI World on a 3-month rolling basis since 2015. And what we're showing you here is that in 2/3 of the cases of these 3-month rolling periods, the fund has performed and has outperformed the index. So it's just a highlight to say that it's one of the attributes of what we do, that of course there will be setbacks, and of course there will also be correlation with markets, but the resilience of the portfolio and the prospects mean that we are able to outperform in 2/3 of the cases. And with that, and in conclusion, I just want to highlight then what it means for us in terms of where we stand with the portfolio, in terms of its profile and its prospects. We clearly are to some extent at another one of these turning points, as I mentioned, when we're going to look forward to the end of this year and to the beginning of next. But what matters for us is the fundamentals of the companies we invest in, the quality that they have, and the prospects. And we certainly think that it's worth the price. We've put together here the numbers for the portfolio as a whole, and you can see that it has very substantially higher revenue growth of close to 11% that we're expecting for the portfolio in 2024. We expect it to have 16% earnings growth compared to 10% for the index, and margins of 24% compared to 10%. So a much more fundamentally attractive portfolio. And the important point is, if you look at the weighted average price to earnings ratio, again, as a shortcut and as a comparable to other valuation methods, you can see it's only trading at a roughly just over 20% premium. So you have a portfolio that has the quality that we've been talking about, that has the attributes of being able to benefit from some of the big drivers that are driving disruption, that are driving capacity needs, that are driving and enabling sustainability as an opportunity, not as a risk for the businesses that we're invested in, with quite a modest valuation premium compared to the market as a whole. So we think ultimately that is what is going to determine the outcomes. It means that if there's a setback, I think the portfolio at these valuations will be resilient. You've just heard that a number of stocks, NVIDIA, our largest position, best performer, is at attractive valuations. You've also just heard that Raytheon, RTX, one of the great companies in the world that has been a strong performer last year, has a setback this year, is on 13 times. These are very low valuations that we think make it very attractive at this point in time. And to highlight then further, the carbon intensity that comes with the sustainability of the companies that we've invested in is very significantly lower. You can see here that it's 80% less than that of the index. So it's one of the reasons why we think our companies will have a positive impact, not just because of the performance that they can generate, but also because they're aligned with some of these big drivers. They're aligned with the SDGs, and they're helping to make the world a better place in many ways.